Coming up on the Danny Moses Show, Wall Street loves using letters and acronyms to describe both products and the economy. Today I will try to explain why you might be hearing more and more about a K-shaped economy. Plus, my guest was voted Wall Street's #1 portfolio strategist for the past 2 years. Michael Kantrowitz from Piper Sandler will join me, and he has his own acronym to describe the markets. And of course, we will get to my Kalshi picks of the week.
Over 30 years of beating Wall Street, predicting the famous Big Short. Now, he's here for you. This is the Danny Moses Show.
If you've been watching or reading any financial media over the last year, or have tuned into this show, you might have heard the term K-shaped economy. Well, what does that really mean? What this means is that the economy continues to be bifurcated, and there has been a continued divergence between the haves and the have-nots. Those making more than $150,000 a year considered upper class, and those below representing the middle and lower class. Within those groups, the upper class, or top part of the K, has been in a position to both invest in the stock market and other investment products, as well as get the benefit of rate cuts and the uptick in home prices, while the bottom half of the K continues to scramble to make ends meet as higher prices on necessities like food and health care and cost of living outpaces income. Just looking at this chart, you can see the K as the top 20% of earners in the U.S. account for roughly 60% of the spending. According to the Federal Reserve, the wealthiest 10% of Americans own roughly 87% of the stock market, and the poorest 50%, just 1.1%. Just looking at Walmart, who has reported their earnings this week and their stock performance over the last several years, and you can see that they have benefited from the K-shaped economy as they have attracted more middle-class consumers looking for cheaper alternatives. We have seen similar trends at Costco and Amazon as well. I will note, however, that Walmart's guidance for sales and earnings this year is now slightly lower than what analysts were looking for, maybe more signs that the bottom half of the K is barely keeping pace. The wealth effect that asset prices, including investments in real estate, have had on the high-end consumer is pronounced, and some of that wealth has been redistributed into the economy, namely in services. Look no further than airlines, who have been describing the K-shaped economy perfectly, as companies like Delta describe how the front of the plane is full versus the back, and how higher-end consumers are carrying the load. While the good side of the economy has had its ups and downs ever since COVID, and through the on-again, off-again tariff policies, the one consistent and growing part of the economy has been services. I already mentioned air travel, but think of hotels and leisure, restaurants, and experiences in general. Since the end of the pandemic, we have seen a change in consumer behavior and a willingness to spend, and consumer spending represents roughly 70% of U.S. GDP. Here is where I see the risk. It's hard in this current environment to see how the bottom slant of the K can work its way higher and/or narrow the gap to the top, given the treadmill many face just trying to keep up with the increased cost of living. But there is a scenario I see where the top end of the K might work its way lower. Any change in discretionary income from the upper end of the K, whether caused by an AI-related job loss or sell-off in the markets, would certainly have an impact on spending, and specifically the services sector, which has been carrying the economy. According to Moody's Analytics, the top 10% of earners account for almost half of the spending in the economy, and this creates a structural risk. Stocks in various sectors, including retail, have begun to mirror the economy, whether it's luxury or necessities, and the stock market itself is heavily concentrated, where a handful of companies levered to the AI trade dominate market performance. While other letters have been used at various times to describe the economy, like U and the infamous V-shaped recovery we saw post-COVID, I am concerned the current K-shape might lose a bit of its upper slant and at the very least turn into a lowercase k from the capital K. When we come back, I sit down with Michael Kantrowitz, Chief Investment Strategist and Head of Portfolio Strategy, Piper Sandler, who has its own letters to describe the economy.
The Danny Moses Show is sponsored by Kalshi.
Michael, great to have you on the show. I'm going to introduce you to our audience by the name Wall Street knows you, which is Kantro. We will get into your favorite acronym in a moment, but first I want to get your take on this.
Now, inflation was, surprised on the downside, growth surprised on the upside, but didn't surprise the White House either time. Our expectation is that there's a big productivity boom, which gives you high growth and low inflation. And so against that backdrop, we think there's plenty of room for the Fed to cut rates.
So, Michael, can we have it both ways? Talk about what Kevin Hassett just said.
Well, I think incrementally he's right. Inflation data has come down. The economy continues to be strong, but on both sides of that story, the economy definitely still shows signs of a bifurcated K-shape. And in the inflation data, while it's come down, price levels are still very high. So we're still in what I believe is a bit of a secular affordability problem in the U.S. economy.
Well, I would just add that if you want to talk about how strong the economy is, it's hard to talk about cutting rates at this point, but that's a story for a different day. All right, so your favorite acronym is HOPE, and we're going to walk through each letter and why they are so crucial, and I'll have questions around each of these, and that's housing, orders, profit, and employment. I opened up the show talking about the K-shaped economy and the consumer. In your latest note, you discussed the broadening out of the economy and how that might impact the markets and investors, but is it enough to help the lower middle income consumer either through wage gains or lower their cost of living?
I think, again, incrementally, yes. Is it going to solve the broad affordability issues we have today because of the price shocks and increased interest rates since we've had in the last few years? No, but I think at the margin, it should incrementally start to feel better than it's been in the last few years as we continue to have low energy prices. Interest rates, particularly mortgage rates, are flirting with getting to a 5% handle. And I think there's a lot of positive momentum in the economy. And later in the year, we should start to see better employment data. So I think we're on the way to healing, but it's not going to be a quick fix.
So how do you see the trade-off between the amount of economic activity kind of created by this growth in AI, such as from construction, obviously, and the impact that it might have on the employment picture longer term?
Yeah, that's definitely a big question. The market's obviously trying to figure the answer to that out. In the last few weeks, we've seen a lot of stocks that have been getting hit by the fear of disruption. And even there's been quite a bit of a concern around the labor market, not necessarily looking at today's data, but fearful of where job losses may accumulate from AI as it continues to propagate throughout the economy. So I would say, I think there's a couple of silver linings today. And in a way, I think a little bit back in the early 1980s, after 10 years of sharply rising inflation. And back then, we similarly had an affordability problem, both in housing and everyday costs of living. And ironically, one of the things that took place in the early 80s throughout the next 2 decades was the US economy started losing a lot of jobs in manufacturing as those went overseas. But the ultimate benefit to the economy showed up in lower inflation and lower interest rates. And that did take almost 20 years. Because if you look at the late 90s, that was the highest reading in consumer confidence in history. So the parallel here to me is that in order to help solve the affordability problems we have today, you have to go through a little bit of pain, and that means some creative destruction and companies going away, jobs going away. But ultimately, we should come out of this as a broader economy in a better place with higher productivity levels, lower interest rates, and lower inflation. But again, it's going to take a very long time. That's something I'm really confident about. I'm not concerned that in the next 3 or 6 months that the unemployment rate is going to spike due to AI job replacement.
I guess it depends on where those jobs are being lost potentially in the white-collar world, which again is the top part of the K in terms of K-shaped economy. So within that, how about the wealth effect that's been created by the stock market, which is obviously levered to the same AI trade, and those at the top of the K economy? The stock market sells off. It feels like it'd be self-fulfilling, and that could really impact the economy and spending.
For sure. Yeah, the size of the U.S. stock market today is more than 2 times the size of the economy, the largest in history for sure. Almost, suggesting that the stock market's become too big to fail because of that very reason. A sharp, sustained downturn would likely have a much bigger negative impact in the economy than ever, given its size. Also, in terms of the wealth effect, when you look at consumer net worth, it is now about 8 times the size of income. So again, the value on consumers' balance sheets of everything from housing and equity securities is enormous. And as you pointed out, a lot of it is in the older cohort, the baby boomers, and those in their mid-40s and 50s that own assets, including equities and houses. And that is definitely something propelling the economy. But again, it does make the stock market an even more important policy tool or lever for the administration to tinker with to keep things afloat in the economy.
I pointed out earlier in the show about the services side of the economy, which is driving things. You've pointed out recently the good side of the economy. It looks like we're finally seeing some growth, but is it a catch-up from the end of last year, a result of the government shutdown and just a replenishment, as well as a pull forward as fear of more tariffs are on the horizon?
I think those could be contributing to it, but I think it is the beginning of a broadening macroeconomic backdrop in the United States, something we have not seen since 2021. It's coming on in the wake of a year and a half of the Federal Reserve lowering short-term interest rates, mortgage rates coming down from over 8% in 2023 to just about 6% today, lower energy prices, and all of the fiscal tailwinds coming out of the administration that are kicking in this year. So I think the improving breadth we've been seeing in the purchasing managers' indices that are a good reflection of manufacturing activity, the breadth we're seeing now that it's been improving for the first time in 3 or 4 years is here and the beginning of an uptrend. And importantly, it's being corroborated by other macroeconomic data. And this is why I would disagree that it was a one-off due to the shutdown or something weather-related or fear of tariffs that are coming. We've also seen an incremental improvement in small business confidence. So the NFIB survey, a lot of data in there. And one data point that I pay attention to each month is how small businesses feel about their sales outlook. And that data typically moves with this manufacturing data, and it is as well has been strong over the last couple of months. So there are a lot of data points that suggest that this is the beginning of a new trend.
Well, I think the broadening out of the economy is good. I just don't think people own the stocks outside of kind of tech and AI right now. So would the fear be you reallocate into these other sectors, potentially the tech kind of stocks sell off, which is where the wealth effect kind of is? What does that look like? And follow-on question to that, Michael, is the fact that rates, 10-year yields, let's say, certainly the economy can handle rising yields to a degree. Is there a level where you would start to be concerned, or as long as rates are going up for the right reasons, it's not an issue?
Yeah, so the first question on tech stocks, and yes, those have been the darlings for the last 3 years, and rightfully so, because that's where the earnings have been rising since 2023, whereas most of the rest of the stock market, especially when you look at smaller cap in areas like the Russell 2000, earnings were declining in 23, 24, and 25, now starting to rebound. So in a way, as we came into 2023 and you had the beginning of the AI boom taking place, at the same time, the K-shaped economy was really becoming evident as small businesses and consumers were suffering from higher interest rates and higher prices. 3 years later now, I think we're beginning to unwind on both sides. There's increasing fear of too much CapEx in the AI space, as well as disruption in many of the more expensive areas of the market like software. And on the bottom leg of the K, we've seen lower interest rates, lower energy prices, and we're beginning to see that reflected in better housing data and better manufacturing data and better, broader earnings data. So to me, this rotation makes sense. It's something we called for beginning first and last September. And the data we continue to see gives us confidence that it will be sustained, unlike many of the periods of the last 3 years where you had 3-4 weeks of the market broadening out and small caps working, and then it all failed. The difference today is that move in the rotation of the market, especially from the cyclical and more value areas of the market, is coming from improving earnings and macroeconomic fundamentals for the first time. Your second question on interest rates, certainly we could withstand higher rates from here, but if mortgage rates start to move up too sharply, you really kill the opportunity for housing to incrementally continue healing and likely take out some of the tailwinds from a sustainable period of expansion in manufacturing and transportation in the economy. So lower rates is certainly what has got us here. And the question of can rates stay low going forward to allow this soft landing to evolve will be really important for the stock market, of course, this year.
Well, you mentioned that owning stocks in consumer discretionary, certain financials, industrials, if rates are dropping for the right reasons, right? But if the rates are dropping because of a slowing economy, will a rate drop be enough to offset the drop in activity? And to get to housing, which I know is extremely important to you, how does that fit into that thesis if employment takes a hit as a result?
Yeah. So in the last 2.5 years, the Fed has cut interest rates and the 10-year has declined, I would say largely in part due to the labor picture softening and the unemployment rate moving higher. And I've actually been arguing for the stock market that's been a positive because of the aftershock of the 2022 inflation scare and all the anxiety that's created in recent years and fear about inflation coming back and interest rates moving sharply higher. One way to certainly get interest rates lower is to see some softer employment data. And so on the positive side of things, that has helped the Fed cut rates, and it's taken a moderate increase in the unemployment rate. Certainly by historical measures, the unemployment rate today at 4.3, 4.4% is still quite low, but it's not as strong as it was obviously 2 years ago. But I think, again, the cost of that has been a positive in that we've gotten lower energy and interest rate prices.
Well, I would tell people, Kantrowitz, you've been right on mostly everything, and people should definitely be listening to you. I can't thank you enough for coming on and joining me today on the show. Look forward to having you back on, and keep up the great work.
All right. Thanks, Danny.
When we come back, my Kalshi picks of the week.
The Danny Moses Show is sponsored by Kalshi.
Welcome back to the Danny Moses Show. It's time for my Kalshi picks of the week. Remember, when you are trading on Kalshi, you are trading with other users, similar to buying or selling a stock, and you can jump in or out of your position at any time to lock in a profit or cut your losses. These are just my opinions, not telling you what to trade or offering any investment advice. Before I get to my picks this week, it is worth highlighting that the Federal Reserve just issued a research report titled Kalshi and the Rise of the Macro Markets, and said this: our results suggest that Kalshi markets provide a high-frequency, continuously updated, distributionally rich benchmark that is valuable to both researchers and policymakers. Take that, economists. This week, I wanted to update you on a few picks from previous shows and provide updated thoughts. In our first episode, I brought up the contract, will Bitcoin outperform gold in 2026? Since then, gold has continued to outperform Bitcoin, and while choosing no has been steadily increasing and now sits at 66 cents, I would be adding to that position. As we see here today, gold is up roughly 16% for the year, while Bitcoin is down roughly 25%. That is a 41% spread at the moment. In the second episode of the Danny Moses Show, I showed a contract, will the S&P 500 finish positive this year? At the time, I said no. And while the S&P is down slightly since that time and basically flat on the year, the no contract is still sitting at 35 cents, and I do believe the market is poised for a bit of a correction, and I see the no contract trading higher from here. Again, these picks are not financial advice, but if you want to learn more, download the Kalshi app, read the rules, and use promo code MOSES to get $10 when you trade $10. Back with my closing thoughts in a moment. Thanks again to Michael Kantrowitz for joining me on today's show. I hope you enjoyed this episode, and regardless of where you sit within the K of this economy, you have a better understanding of what's driving the markets. Please tune in next week for a special State of the Union episode of The Danny Moses Show, and then another episode of The Danny Moses Show on Friday. In the meantime, you can follow me on various social channels or go to DannyMoses.com, where you can find links to my latest posts and appearances, including the What Are We Doing Substack I co-author with my fellow Big Short partners. And watch these episodes anytime on scripsnews.com/Danny Moses. So until then, I will keep an eye out in the markets for what everyone is talking about, what nobody is talking about, and what I think matters most to you. I'm Danny Moses.